Let's talk real estate, the classic symbol of success, wealth, and stability. For generations, owning property has been seen as the ultimate achievement, a way to put down roots and build a legacy. Traditionally, owning property meant saving for years, taking out a huge loan, and spending decades paying it off. It was a slow climb, requiring discipline, sacrifice, and a lot of patience. It's a massive commitment, not just financially but in time and effort. The paperwork alone can be overwhelming, and the stress of managing a mortgage can weigh on you for years. Even a small home can cost hundreds of thousands, and commercial properties are even further out of reach. Prices keep climbing, making it harder for everyday people to get a foot in the door. Then there's the hassle. Late-night repair calls, finding tenants, collecting rent, and dealing with taxes and insurance. Being a landlord is a full-time job in itself, with constant demands and unexpected problems. For most people, the high costs and headaches make large-scale real estate investing impossible. The barriers to entry are just too high, and the risks can be intimidating. The big money, steady, passive income from major properties, has always been reserved for the ultra-wealthy. They're the ones who can afford to buy entire buildings and reap the rewards. Most of us are left watching from the sidelines as property values rise and investors collect rent. It can feel like the door to real estate wealth is firmly closed to everyone else. Real estate is a proven way to build wealth, but the traditional path is just too demanding and risky for most. The dream of owning a piece of the city often stays out of reach. You'd need a ton of capital, specialized knowledge, and a willingness to deal with endless landlord headaches. It's no wonder so many people give up before they even start. For a long time, there simply wasn't another way in. The system was built to keep most people out, and only a select few could break through. But that's about to change. A new era of real estate investing is on the horizon, and it's opening the door for everyone. What if you could invest in massive income-generating properties like bustling office towers and sprawling shopping centers, without needing millions of dollars or ever fixing leaky faucets yourself? Enter real estate investment trusts, or REITs, your gateway to real estate investing. Just like buying shares of Apple, you can buy shares of a REIT and instantly own a slice of a real estate empire. With just a few dollars, you can invest in professionally managed properties across the country and earn a share of the profits. No landlord duties or headaches required. REITs have truly democratized real estate investing, making it accessible to anyone with a brokerage account and a desire to grow wealth. So what is a REIT? It's a company that owns and operates income-producing real estate. REITs pool money from thousands of investors to buy and manage properties, apartments, offices, warehouses, hospitals, and more. To qualify as a REIT, a company must invest at least 75% of its assets in real estate and earn most of its income from rents or mortgage interest. The key REITs are legally required to pay out at least 90% of their taxable income as dividends to shareholders. This means steady, predictable income for investors. The REIT's management team handles everything: leasing, maintenance, collecting rent, while you collect dividends. You get the rewards of real estate ownership, without the headaches. It's real estate investing simplified. Not all REITs are the same. There are three main types. Equity REITs own and operate physical properties, earning money from rent. Think logistics warehouses or apartment complexes. Mortgage REITs or MREITs don't own buildings. They invest in mortgages and earn interest. Hybrid REITs combine both strategies, owning properties and investing in mortgages. Each type comes with different risks and rewards. Equity REITs are generally more stable, tied to long-term leases. Mortgage REITs can offer higher yields but are sensitive to interest rates. Hybrid REITs blend both approaches for diversification. Before investing, know which type you're buying: buildings, debt, or both. Understanding the differences is crucial for managing risk. The main way REIT investors make money is through dividends. These regular payments are what make REITs so attractive to many people looking for steady income from their investments. REITs are required by law to pay out at least 90% of their taxable income to shareholders, and this income usually comes from rent collected on their properties, like apartments, offices, and shopping centers. For example, if a REIT earns $1.4 million after expenses, at least $1.26 million must be distributed to shareholders as dividends. This ensures that most of the profits flow directly to investors, rather than being kept by the company. If there are 1,000,000 shares outstanding, that's $1.26 per share per year. The more shares you own, the more dividend income you receive. For instance, if you own 100 shares, you'd get $126 annually, typically paid out in 4 quarterly installments. This can be a reliable way to supplement your income. It's a steady, passive income stream, like getting a rent check every few months, but without the hassle of being a landlord or managing tenants. Plus, there's potential for capital appreciation if the REIT's properties grow in value over time, which can boost the share price. As the REIT acquires more profitable assets and expands its portfolio, share prices can rise, increasing the value of your investment. So, you earn both regular dividends and the chance for your investment to grow in value over time, creating a powerful, wealth-building combination. That's the double benefit of REITs: steady income and long-term growth potential, all in one investment. REITs offer instant diversification. Owning shares means exposure to dozens or even hundreds of properties across different sectors, like offices, apartments, shopping centers, and warehouses. This broad reach helps investors tap into multiple real estate markets at once without needing to buy physical properties themselves. This spreads out risk, unlike owning a single property where your investment depends on just one location or tenant. With REITs, if one property underperforms, others can help balance things out. REITs are also highly liquid. You can buy or sell shares on the stock market in seconds, just like any other stock. This is a huge advantage compared to selling a house, which can take months and involve lots of paperwork and fees. The required high dividend payouts often mean better yields than most stocks or bonds. By law, REITs must pay out at least 90% of their taxable income as dividends, so investors often enjoy a steady stream of income. This makes REITs especially attractive for those seeking reliable, steady income, such as retirees or anyone looking to supplement their earnings with passive cash flow. You can also reinvest dividends to grow your investment even faster, taking advantage of compounding returns over time and building wealth more efficiently. Plus, you benefit from professional management. Experts handle the properties, tenants, and finances, so you don't have to worry about day-to-day hassles or maintenance issues. You get access to top-tier real estate deals and expertise without the hassle or high fees that come with direct ownership or private investments. REITs make real estate investing simple, flexible, and accessible to almost anyone, regardless of experience or starting capital. That's why they're a true game changer for everyday investors, opening doors to opportunities that were once out of reach. Of course, REITs aren't risk-free. They're sensitive to interest rate changes. When rates rise, borrowing costs go up and REIT prices can fall. REIT shares can be volatile, moving with the stock market even if the properties are performing well. Sector risk matters too. REITs focused on malls or hotels struggled during the pandemic, while data centers thrived. If you invest in a single sector REIT, you're exposed to that industry's ups and downs. Management quality is crucial. Poor decisions can hurt income and share prices. Always research the REIT's management, property portfolio, and financial health. Not all REITs are created equal. Choose wisely. Understand the risks before you invest. With the right approach, REITs can be a powerful tool for building wealth.